Hello everyone. Our video class today will be about cost and volume and profit analysis, focus on break-even points. That's a very easy topic. We have only to understand our logical approach and the concepts around this. So we will work much better if we try on a Excel spreadsheet. So let's go there. Oh, let's go here. Here. Good, very good. So let's work with a product X with, for example, unit sales price of 200, unit variable cost of 120, and unit contribution margin of 80. And what is the contribution margin? Is the contribution that each product gives to the company to pay the fixed costs and to, to have a net income. So as we are working with unit sales price, unit variable cost, we will work with unit contribution margin. And the formula is unit sales price or sale minus unit variable cost or variable cost. And our fixed cost of $180,000, for example. So we will work with the basic formula of net income. That is sale minus variable expenses minus fixed expenses. And we are working only with cost. So sale minus variable cost minus fixed cost equal to net income. And what is sale? Sale is unit sales price times number of units. And variable cost is unit variable cost times number of units. So our net income formula will be unit sales price times number of units minus unit variable cost times number of units minus fixed cost equal to net income. And we want to know the number of units. So unit sales price times number of units minus unit variable cost times number of units equal to fixed cost plus net income. And we have number of units on both factors of our left side of the formula. So number of units plus unit sales price minus unit variable cost equal to fixed cost plus net income. So number of units equal to fixed cost plus net income divided by unit sales price minus unit variable cost. And what is break-even point? Break-even point is the number of units or the amount of sales where net income is equal to 0. So our break-even point will be fixed cost plus 0. So we do not have the net income on our formula, divided by unit sales price minus unit variable cost. Or remember, what is unit sales, what is contribution margin? Contribution margin is unit sales price minus unit variable cost. So break-even points can be written as fixed cost divided by unit contribution margin. So our values I pasted here. So break-even point, fixed cost $180,000 divided by unit sales price 200 minus unit variable cost 120. So break-even point is $180,000 divided by 80, that is the same number of unit contribution margin. That's why our formula can be written as fixed cost divided by unit contribution margin. That's fixed cost divided by unit contribution margin, 2,250 units. And if we want to know the amount of sales, just units times unit sale price, $450,000. And it's very easy to see if we plot the numbers on a graphic. Only put this graphic a little smaller. Okay. So we have two lines, the lines of sale, the line of cost, and we have the blue line of sales. The starting point is 0 because if I sell 0 units, I will have $0, and it grows as we sell more units. And the cost line, the red one, does not start on 0 because we have the fixed cost that is $180,000, and it's growing as we sell more units, but growth is lower than our sales line because our sales price is higher than our variable cost, 200 against 120. And where the lines touch each other, we have our break-even point. Sales equal to total cost, net income equal to 0. So from the break-even point to our left, we have a loss because our cost line is higher than our sales line. And to the right, we have a profit because our sales line is higher than our cost line. And what about the behavior about the cost and price? For example, if we have the same unit variable cost, but a new fixed cost, for example, $290,000. Let's check it. Here we have a new cost line that's parallel to the old one because of our variable cost is the same, but it's higher than the old one because our fixed cost, that's our starting point, is a new starting point. So our break-even point will move to here. It's higher than the old one because we have more cost and the same sale. But if we change not the fixed cost, but the variable cost, for example, to 140, we have the same starting point, but the line grows faster than the old one because of the amount of variable cost that's higher than before. So our break-even point will be higher than the old one. And if we change not the cost, but the sales price to 245, we will have a new sales line, the green one. So we have the same starting point of 0 that's on every sales line, but our break-even point will be lower because our sales line grows faster than the old one. And if we change everything, unit variable cost 140, fixed cost 290, we will change everything on our lines. We will change the sales line, we will change the cost line, so we will have a new break-even point as well. And Another thing that's very, very important, if I do not want to know the units of our break-even points, but only the amount of dollar, only the sales, how can I work with it without doing this lot of formulas and so on? Let's go to plan 2, where we have the same values as the plan 1, as we can see here. So plan 2, we have here, let's erase this for a moment, as well as here for a moment too. We work not in value, but in percentile also, percentile related to the unit sales price. So the first one, 100%. The second one, unit variable cost divided by unit sales price, 60%, and unit contribution margin, 40%, because unit contribution margin is unit sales price minus unit variable cost. So our formula will be not with values of sales and variable expenses, that in our case variable cost, but related to our sales. So we have sale minus variable cost is 60%, so 0.6 times sales, minus fixed expenses, that is our fixed cost, 180, equal to 0, because on break-even point, remember, is the point where our net income is equal to 0. So sales minus 0.6 sales is 0.4 times sales, equal $280,000. So sale is equal to 180,000 divided by 0.4. So 180 divided by 0.4, the same $450,000 than before. So why do we have to do this if the first methods give us the same number? Is it useless? No, it's not useless, because when we have a lot of products, or either we appropriate all fixed costs to each one of products, that a lot of researchers and analysts say that it's incorrect, or we work with the average of unit of contribution margin, of all the products, as we can see on our plan 3. Here we have 5 products with unit sales price, unit variable cost, and unit contribution margin. The number of units, you can get it on a time series. For example, the number of the last month, or an average of the last 3, 6, or 12 months, no more than that. And then our sales, unit sales price times number of units, in this case 96,000. Variable cost, unit variable cost times number of units. And contribution margin, sales minus variable cost, for each one of our 5 products. And we have a sum of it. Sales $890,000, variable cost $606,000, contribution margin $284,000. So the same formula as before, the percentage of variable cost and contribution margin. If we have a fixed cost of $230,000, our break-even point will be 230 divided by 0.3191, $720,774.65. And you can see that it's much easier than if we appropriate this fixed cost to all of our products and so on. So we have a full break-even point of $720,000, and we can choose a lot of combinations of each one of our 5 products to have our desirable sale and desirable break-even point. And we have a lot of other methods for break-even points in multiple products, but this is the easiest one. So that's it for now. If you have any questions, suggestions, or comments, please email me on jscarping@gmail.com. And we are on Facebook, on a page, and also a group called Accounting 24/7. That is the name of our YouTube channel. Okay, see you later. Bye.